Hello and welcome to Askimo TV. Today we're sitting with Michael Friedman, the Executive Director of Asquith Merchant Bank, and we're talking about merchant banking. And we're going to talk about the question today of what should I invest my savings in? Now more than ever in this economic climate, it's hard to know how to protect your savings and maximize them. So Michael, can you perhaps talk a little bit about what is the most reliable or risk-free way to protect your savings?
Well, the first thing to say is the standard disclaimer that you'll hear from anybody in the investment community, which is, I'm not your financial advisor. You must seek your proper financial advice from somebody who knows your affairs, is sophisticated enough to help you, and is in your jurisdiction, etc., etc. So I will assume a level of knowledge and sophistication from your viewers before I continue. So the first question that you have to ask yourself is how much do I have, and how much can I live without? And I would say that those are your first two choices that you make when allocating assets. By assets, what I mean is effectively the money that you save. So you really have two decisions. The first is you can take a view that you've got your money, you just want to keep it somewhere safe, you want it to grow at a very low amount, and you therefore can put it into a savings account with a bank. Now, if you're in, for example, the United Kingdom or almost any country in the Western world, then unless you're very, very rich, your first 50 or 100,000 pounds or dollars or euros in almost every country is protected by the government. So in the event that for some reason the bank that you put the money in actually collapses, the government will act as your insurer and will ensure that your money is kept safe. So basically the most boring thing you can do with your money is absolutely nothing. And at the moment that would mean that you make a small interest rate every year which is paid into your account. Now certain governments provide incentives to save over a slightly longer term and to take that money away from where you can spend it every day. And they do that because they understand that the public sometimes gets a little excited about money being in their bank account, and the expression for the money to burn a hole in your pocket is quite well known. So in the UK, that takes the form of special savings accounts, such as Tessa, which was a sort of historical account, which used to pay something like £3,000 a year into. And there are all sorts of provisions that are made in every country that encourage you to save a small amount every month into such an account. And that pays a higher rate of interest usually, which is because the institution you're putting that money into knows that it's going to be keeping it for a while longer, so it can afford to pay you more on it. And also the biggest upside is that it's tax-free. So normally you pay tax on the interest that you make on your savings. But in such tax-free accounts you don't. So actually the money that it looks like it pays, it really pays you and you get to keep that net. So there's a benefit to doing so. Obviously, there are stipulations about how long you must keep the money before you are allowed to take it out tax-free. The most boring thing you can do is just leave it in the bank in some account or other. And depending on your bank and which country you live in, you may find that there are various forms of that actually give you quite an attractive return. Then the second most conservative thing that you can do with your money is to look at buying bonds. Bonds are a really tedious asset class. And basically, when you buy a bond, what you're doing is you're effectively lending money to whichever company or country even is the issuer of that bond. So in the UK, these bonds are called gilts, and that's a process by which the UK Treasury decides that it needs to raise more money to invest in roads or schools or education or anything else. And so it goes to the market and it says, right, we'd like you to lend us, the UK PLC, UK as a company as it were, several billion pounds, and you give your money to the government, and over a period of maybe 3 months right up to 20 or 30 years, it will pay you back that money with a form of interest on top. And again, there are several different structures by which it can do that. In the US, those are called treasuries. In Germany, they have a variety of different names. They're called Schatzes and Wobbles and Bunds, depending on how long they last. And that's a process by which you effectively lend money to a government. And those are called bonds. And also there are corporate bonds, so companies can go through the same process. And again, those tend to be very secure. And what you read about in the newspapers is that there are ratings that are given to each country and to each major company by 3 or 4 major ratings agencies. So the highest you can get is usually something that has lots of A's in it, depending on which of the rating agencies, AAA or AA or AA1 or so on and so forth. And you decide on what your tolerance for risk is. In other words, how prepared are you to potentially lose your shirt? Usually anything that is even remotely got an A in the rating is likely to be almost foolproof, but nothing is ever perfect. And we've seen examples of really highly rated companies that have collapsed. And actually a lot of the reason for the economic collapse that we saw in the last few years is precisely because things were dressed as very highly rated bonds and actually turned out not to be. So one should always be aware of that. So that's really a secondary conservative option you have. And then you can basically go all the way through from that end through 100 different asset classes down to things which are pretty high risk, which could involve starting your own business, backing someone else to start their business. It could involve deciding that you know something about horses or something about the way the roulette wheel works, and you can go and put your money there if you deem that to be your tolerance for risk. So that was why my initial point was you have to decide what you have to invest and how much you're prepared to lose. So any asset allocation has to be based on that decision. I have, I don't know, let's say $100,000 that I want to invest somewhere, out of which I know I have to have $90,000 pretty safe. So I'm going to put that $90,000 into something pretty boring. And there's $10,000 that I'm prepared to take a chance on. If I lose it, I lose it. But on the other hand, I'm prepared to potentially invest it in things that might really seem make a very good return. And those are the kind of decisions that you have to make. And your tolerance for what you're prepared to lose really determines where exactly in that range of investments you place how much of that capital you have at your disposal.
So it sounds like there's a huge range of options, and it's really for the individual to make a decision about the level of risk that they're willing to take on. And what you've also mentioned, which is interesting, is you can even split your own pot of money. So you might try to play it safe with a certain amount and then be a bit more risky with the remaining amount.
That's right. Basically, anybody who has a pot of money to play with beyond a very small amount has to make some kind of allocation decision. So normally one considers there to be a pyramid of risk. So risk and return tends to be fairly well correlated. So the higher the risk, the higher the return. The lower the risk, the lower the return. So as I said, you have to decide how much are you prepared to speculate not at all, how much are you prepared to have that's highly speculative, and then you kind of get a grip on what looks like the middle ground and how much you're prepared to risk. And that can be a variety of factors. It can be to do with how much capital you have, how much you need, how much do you need to see annual returns versus just capital gains that are appreciating in the background. And that's not just a decision of your lifestyle, that's also a decision of the tax consequences, because the tax can vary really greatly between the amount of money you earn in a given year and the amount of capital gains that are just rising in the background that you don't crystallize. In other words, let's say you invested in Facebook 5 years ago, and today it's worth 100 times what you paid for it. During that 5 years, you won't have been taxed at all. And actually, you've just seen this massive appreciation. And not only that, but if you invested in the right way, you may find that you still pay a low tax rate, even when you finally sell your Facebook shares. On the other hand, you could have invested in something that paid you dividends or interest every year, and every year you might have been hit with a 30 or 40% charge on your gains. And so that might have had some effect on your original decision making if you'd have understood that. You have to take a lot of things into account.
Okay, and finally, you mentioned at the beginning of this segment that everyone would need to seek professional advice when they're looking at their own portfolio or looking at their own financial circumstance. What sort of person would you recommend that I would go to or someone would go to get advice about my own particular financial situation?
Sure. I think that most people who are in any position to make such an investment, anyone who's doing anything beyond keeping a few £1,000s in a savings account, is probably already employing an accountant, for example, and they would probably be a very good first port of call. And then you have a variety of other professional advisors who you meet on a day-to-day basis. So again, if you have more than a certain amount saved at a bank, probably you may have a relationship with your local bank manager, and they may be able to give you some advice, because the bank itself may have a variety of products that could be suitable for your needs. Beyond that, you have your lawyers who may also be aware of transactions in the market that could be interesting to you. They may understand your tax position, your legal position in a new way that lets you consider different things. I think it really is very simple in terms of how much thought you really have to give to these things. There is a definition in each country as to what is a high net worth individual or a sophisticated investor. And that normally involves either being someone who is deemed to be a professional, someone who has access to deal flow, someone who's involved in the commercial space, such as an accountant or a lawyer, or somebody who's just earned enough over a period of time and probably invested enough over a period of time to be considered at such a level. If you don't tick any of those boxes, you probably don't have to think too hard or go too wide to work out what to do with your money. The answer is you probably don't have a huge amount of money to invest, and you probably need to be sensible about what you do with all of it. And therefore, your decision making is pretty narrow. That means speak to your accountant, understand who else in your family is doing what with it. Understand also that investment is also a lifestyle choice. So, for example, people who buy their own homes, in reality, that's also an investment. It's the single biggest investment decision most people will ever make. And so it even comes down to making a simple decision. Would I rather have disposable income in my bank account and continue to rent my apartment, or do I actually think that I've got to a point in my life where I wish to buy a house? And actually, even that is part of your investment decision making. And I think that what people often do is they try to take a view that they buy a house because that's what their lifestyle is about, and it has nothing to do with the hard-headed decisions of savings, but actually the two are completely tied, and it's quite important to understand that connection.
Okay, well, thank you very much. That's been really interesting, and thanks for taking the time.
Pleasure.